The commercial real estate industry battered in a post-pandemic world, but our next guest says there are pockets of opportunity within the sector. Joining us now is Brian Klinksiek, LaSalle Asset Management, Global Head of Research and Strategy. Brian, thank you for joining us.
Josh, thanks for having me today.
Maybe Brian, just start, I'm actually just interested to get your kind of 30,000-foot view. We're wrapping up this year, we're heading into 2024. What's kind of your general take on the real estate sector? Because I know you think, just at a high level, it's still unsettled.
Yeah, real estate is still adjusting to the big increase in interest rates that we have seen in most global markets. Interest rates, we've seen a lot of volatility, but the degree of change in the last 18 months is just huge. And it takes time for that impact to translate into the market because the on-the-ground mechanisms that happen is refinancings and all of the issues with capital stacks that have been sort of turned upside down a little bit by lower levels of value, sticky expectations of sale prices by owners of assets. So that process is still continuing and the market is still in a phase of price discovery. But a more stable rates environment, which seems to be in the offing, will help resolve that and will lead to a return of transaction activity in real estate, but at a rebased level. And so that's what we're expecting in the new year. Now, predicting interest rates is notoriously difficult. And so one of the key things that LaSalle is focused on, and my team on the research and strategy side is focused on, is finding value within real estate. Because fundamentally, if interest rates were easy to predict, we'd be making money, buying and selling bonds and derivatives based on those. And within real estate, the opportunity that we see has to do with sectors around rental housing, around logistics, being a lender into real estate because debt lending is the part of the market that reprices the fastest. And so those are some of the pockets that we're focused on.
So what we have seen, we talk more about the residential market, meaning like people buying and selling homes. And there, of course, we have seen a freeze because people have locked in lower interest rates. Is some of that phenomenon happening on the commercial side as well? And so is that why maybe some stability in rates will help unfreeze some of it? I do want to get into the sectors, but I'm curious about this.
Well, the U.S. is very special in a global context from a residential perspective because we have 30-year fixed rate mortgages in the U.S. I actually live in the U.K., and you can't fix a mortgage rate for anywhere near that length of time. And so the U.S. has this unique characteristic, and that has made people sticky to their homes, which has actually put a floor under home prices and pushed some people into the rental market. We continue to see really strong demand in the rental market, which is where we're focused. We're investors in income-producing real estate. And the commercial side, it's a little bit more like residential mortgages in the rest of the world, where they reset more frequently. And so in the next, right now and in the next sort of couple of years, all of those resets and the maturity of those loans are going to have to be dealt with. And they're going to have to be dealt with in the context of property values that are lower than they had been.
And Brian, it's coming back to commercial real estate, when we look at a lot of American cities, downtowns, they still don't feel surely like as full as they used to be, right? What do you think the fix is there?
Well, I think the fix has to do around live, work, and play, and having a mix of activities in city centers. I think I mentioned that I live in the UK, I live in London. And in London, you see very different situations in different parts of the city. So Canary Wharf, which is a district of high-rise office towers, and there's not a whole lot to do other than go to the office, looks a lot like a lot of American downtowns, maybe like the financial district here in New York. And they've had a much weaker return to office there. But in the West End, where my office is, there's go out to dinner, go out to a show. It's a little more like Midtown Manhattan, where I was earlier today, and the vibrancy there is palpable. And so the long run has to be creating a mix of activities and uses that draw people in. The phrase that I use is commute-worthy experience. Is the being in that place worth the effort and the cost and the time and the money and the pain of riding the subway or being stuck in traffic to get there? And I think a lot of American downtowns don't yet deliver that commute-worthy experience.
So getting back to the sectors here, and on a related note, you guys like rental housing, I believe you said. So does that imply that you still think the residential purchase market is going to remain a little bit frozen in the U.S. and there's still going to be strong demand for rental housing.
Yeah, I mean, one of the great characteristics of the U.S. economy is mobility. People will move for jobs, and in this kind of tight labor market, people still need to move, but to buy housing is difficult. There's just nothing on the market because people have these long mortgages, long 30-year mortgages with low rates, and they want to stay in them. And so that's pushing people into rental housing. The fact that prices in for sale housing haven't adjusted much continues the affordability issue with becoming a homeowner. That pushes people into rental housing. One of the subsectors of rental housing we really like is single family for rent. Because just because you're a renter doesn't mean that you shouldn't have to, not be able to consider a house with a backyard and a place to, hang out with your kids. So sort of disconnecting rental versus ownership with the type of housing you want. Not everybody wants to live in an apartment or can live in an apartment with their family situation, which is why we like that subsector as well.
And Brian, I want to get you out into this. COP28, the global climate summit in Dubai, that kicks off tomorrow. When you think about climate change, how does that sort of just shape, influence, and impact your thinking about real estate and real estate opportunities?
Yeah, I'd break it down into mitigation and adaptation. So on the mitigation side, that means reducing climate change. That is, some of the markets where we invest, pretty much all of Europe, Canada, Australia, some parts of the US, there is a absolutely strict regulatory expectation that we will decarbonize real estate, that the commercial real estate sector will decarbonize. Tenants are starting to expect it. So aside from needing to decarbonize because many people think it's the right thing to do, we have a fiduciary duty to our clients to produce real estate that can hold up in the regulatory environment and the demand environment. So that's how real estate is aligning on the mitigation side. Now, adaptation is that the world is changing, and that we're getting stronger storms and sea levels are rising, and making sure that we're targeting investments in locations that are resilient to climate change, where infrastructure is being built that can make it more future-proofed, and figuring out what investments we need to make into our properties to make them resilient to storms. So moving critical equipment from the basement to a higher level in case that space floods, so that we can get back online for our occupiers, for our tenant base in short order after some kind of emergency.
Really interesting stuff. Thank you, Brian. Appreciate it. Brian Klinksiek, thanks for
thank
coming
you.
in.
Josh and Julie, thank you so much for having me.
Take care.